What if the institution you trust with your life savings is secretly gambling with your money? What if the numbers you see in official reports are nothing more than illusions? Banking is built on one fragile foundation: trust. And when that trust breaks, entire economies can shake. Banks are not just buildings filled with cash. They are the backbone of modern economies. They manage savings, provide loans, finance businesses, and support governments. But history shows that behind polished glass towers and professional smiles, some of the biggest financial crimes have taken place. Banking fraud is not new. It evolves with time. From forged documents to digital manipulation, from insider trading to massive accounting deception, scandals have repeatedly exposed weaknesses in financial systems. Let us begin with one of the most shocking collapses in modern history, the fall of Lehman Brothers in 2008. Although not a traditional fraud case, in the simplest sense, its risky practices, misleading financial structures, and excessive leverage contributed to a global financial crisis. The collapse triggered panic across markets and wiped out billions in wealth. It exposed how dangerous complex financial engineering can become when transparency disappears. Another infamous scandal involved Wells Fargo. In 2016, it was revealed that employees had opened millions of fake accounts without customer consent. Why? To meet aggressive sales targets. The scandal showed how toxic corporate culture and pressure-driven incentives can lead ordinary employees into unethical behavior. Then there was the massive Ponzi scheme orchestrated by Bernie Madoff. Though not a bank itself, his fraud deeply involved the banking and financial system. For years, fake returns were paid using money from new investors. The illusion collapsed during the 2008 crisis, revealing losses of nearly $65 billion. It remains one of the largest financial frauds in history. In Europe, scandals such as money laundering investigations involving Deutsche Bank raised serious questions about compliance and oversight. Billions of dollars were allegedly moved through suspicious transactions. These cases highlighted how global banks sometimes struggle to monitor international flows of money. So why do banking frauds happen? First, greed. When profits become the only goal, ethical boundaries blur. Second, lack of regulation or weak enforcement. Financial innovation often moves faster than regulators. Third, complexity. Modern banking involves derivatives, offshore accounts, shadow banking systems, structures so complicated that even experts struggle to understand them fully. Fourth, human psychology. Overconfidence, herd mentality, and fear of missing out can cloud judgment at every level. Technology has added new dimensions to banking fraud. Cybercrime, phishing attacks, identity theft, and digital payment manipulation have grown rapidly. Hackers can now steal millions without ever entering a bank branch. Digital banking increases convenience, but also expands vulnerability. The consequences of banking scandals go far beyond headlines. When a major bank collapses, ordinary people suffer. Savings disappear, businesses close, jobs are lost. Governments may step in with bailouts using taxpayer money. Trust erodes not only in banks but in the entire financial system. After every major scandal, reforms follow. Following the 2008 crisis, stricter capital requirements and regulatory frameworks were introduced worldwide. Central banks increased supervision. Transparency standards improved. Yet history suggests that new loopholes always emerge. The real challenge is balancing innovation and regulation. Banking drives economic growth. Risk is part of finance. But unchecked risk combined with weak oversight can become catastrophic. Today, as digital currencies, fintech platforms, and decentralized finance expand, the question remains, are we building safer systems or are we creating the conditions for the next big scandal? Banking frauds remind us that numbers on a screen represent real lives. Behind every collapsed institution are families, workers, and communities affected by decisions made in boardrooms. Trust is the currency of banking. Once lost, it takes years to rebuild. History teaches one clear lesson: transparency, accountability, and ethical leadership are not optional in finance, they are essential. Because when trust turns into betrayal, the cost is paid by everyone.